Hey, what's up, everybody? Michael Silva here. We got so many questions to answer. Is the stock market heading back into a storm? Is the Fed going to be stepping in? I mean, bank stocks are crashing. Is this the next Lehman moment? What should investors do? We're going to talk about that on today's Stock Market Brief show. Look at the big news that swept the week was SVB, Silicon Valley Bank, the largest bank failure since the 2008 financial crisis, which has people really worried about financial stocks. But don't worry, Jim Cramer's out and about saying that JP Morgan, it's a fortress, nothing to worry about. But also, February 8th, he was saying that one of the top 10 stocks that was intriguing him was SVB Financial. And perhaps you remember back in 2008, he famously said, Bear Stearns is fine. Do not take your money out.
Should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is really, look, if there's one takeaway other than the plus 400 somebody, Bear Stearns is not in trouble.
So we got Jim Cramer saying that JP Morgan is a fortress, and we have big name like Michael Burry coming out and saying, next we find our WorldCom. Patience. Now, I don't know if this is in reference to the dot-com bust or if this is something completely different. He's always sending out those cryptic messages. Bill Ackman recently tweeted that there will be bank runs everywhere on Monday unless the FDIC does a system-wide guarantee. Well, the thing is, FDIC only has $124.5 billion on its balance sheet and $100 billion line of credit. The U.S. banking system is more than $22 trillion. FDIC assets cover only 1.26% of the deposits. So guess what? We need to answer the question, is the Fed going to do something about it? Now, I could show you this chart once again. I showed on the daily on my last video, but understand the KRE, this is the regional banking ETF. This is very important to watch out for, but we just had a week where we were down 16.05%. We have not seen something like that since the pandemic, right? So when the pandemic hit, and then also prior to that was, guess what? The financial crisis. And each of those times should look familiar because what took place? The Fed ended up stepping in. Now, we know about SVB, but that's not the only thing happening right now. We don't know if there's more systematic risk potentially taking place, but you're starting to see things like PacWest Bancorp also massively hit. Things like First Republic Bank of San Francisco. You have lines outside of these banks for depositors trying to get their money. You have USB Bancorp taking a big hit. You have PNC Financial Services taking a big hit. You have Metropolitan Bank Holdings taking a big hit. You have Capital Bancorp taking a big hit. You have Signature Bank taking a big hit. You have Charles Schwab taking one of the biggest weekly hits since the Lehman moment. This is absolutely incredible stuff taking place, so we must be obviously very, very careful in this environment. Look at the yield curves have been deeply inverted, so it's catching up. We've been talking about this since they inverted, and right before they were inverted, that this is not good for financials. And what I find interesting here is that the 10-year and 3-month is now 131 basis points inverted. The 10-year yield backed off, which is something that we've been saying to potentially pay attention to. And then a flight to safety there in bonds. It was up 3.45%. This looks like a duck and cover move. You're starting to see rotation into safety assets such as gold, seeing that big spike there. You can see it was up 1.78% on the day. That TLT crossed over. We discussed that and we've seen that big rip up right there. Also to note, the yield curve inversion is something that we haven't seen since the 80s, and this deep of a yield curve inversion, the most we've seen it dating back to the 1930s that I found was minus 373 basis points. I posted this out on Twitter, but due to the appearance of the inverted yield curves, which has not been seen since the 80s, people are going to be reminding of the savings and loan crisis, also known as the S&L crisis. Now, to address that, the federal government enacted what's called the Financial Institutions Reform, Recovery, and Enforcement Act of 1989. Okay, I'm not going to read this entire thing, but understand that they had key provisions, and one of them was RTC, which is the Resolution Trust Corporation, to manage the assets of the failed S&L and facilitate their resolution. So we're seeing something, very similar as far as the yield curve inversion of where it's at. We're seeing banks start to take a big hit. And now, once again, we're asking the question, is the Fed going to do something about it? And if not, what will be the consequences? I don't have these type of answers. I will go into more detail on the charts of what we can potentially watch for, but understand this is a time to preserve and protect your capital and to be very careful in these financial markets. August 26th, 2022. Remember, Powell was talking about the successful Volcker disinflation of the 1980s, which we had discussed in prior episodes. And he kept mentioning the words, keep at it. We will keep at it. We will keep at it because of inflation, right? And understand that these are, things that Volcker said. It was part of his book, right? His book was titled Keeping at It. So will Powell bend? Will he fold on this strong hawkish stance to save potentially something bigger from taking place? Or are we going into a potential reset here in the financial markets? And, who knows what could come from that. Now, taking a look at the quarterly chart, this is also something that we've been paying attention to, is when we typically get a quarterly close under the 5 EMA, the Fed steps in. The times that we got 2 quarterly closes under the 5 EMA and the Fed didn't step in, we had, the dot-com bust and the great financial crisis. As you can see here, I highlighted the 2 quarterly closes right here and right here. And then you can see over here, we had a quarterly close, a quarterly close, quarterly close, quarterly close, quarterly close. Now, what do all those dates have in common? Well, the Fed stepped in every single one of those times. And as we're standing right now, we had 2 quarterly closes. And guess what? The Fed has not stepped in. So is this going to turn into a potential Lehman moment? Well, I don't, once again, have those answers, but we need to at least be prepared for if something were to take place. If you didn't have the foresight of seeing the possibility of something happening then, but now you do potentially have the foresight of seeing something now, what would you have done during this time? And what can you potentially do to protect your capital and preserve your wealth this time? Now, each of those times, if you want to see the names of what took place, how the Fed stepped in, we had QE2 announced, we had Operation Twist, we had that China stock market turbulence, and then obviously the most recent one was quantitative easing unlimited. Now, we are going into next trading week. Next trading week is incredibly important because we have macro data drops, but not only that, we're going to most likely hear more news about what's going to take place in the case of Silicon Valley Bank. So be on the lookout for more information to come. Now, coming into next week, Tuesday, we have also inflation data. So this is going to be, I don't know if the banks are going to overshadow this, but this is going to be an important macro data drop to watch coming in. Now, this last week, right? So we're looking at a chart of the S&P 500 on the daily time frame. We had an expected move of $77.66. The market moved 184.05. That is over a 2 sigma move in the markets. That, just to remind you, does not happen frequently. Remember, 1 sigma, 2 sigma. Okay, 1 sigma, 2 sigma. 95% of the time, will close within those 2 sigma moves. So that means if we get outside of it, there's only about a 4% probability that we can break those 2 sigma moves. So it's a very rare occurrence, and it just took place, okay? Going into this next trading week, we're looking at a $108 expected move. That's calculating the risk of what's currently going on, right? This is the option market as far as implied volatility goes. And it's also calculating, the possibility of, what might take place with the banks. It's calculating the possibility of what might be taking place with CPI. But understand, we just saw a 2 sigma move. So what would a 2 sigma move look like going into next week? We would be looking over 200 points moving on the S&P 500. Now, if we just stay within the 1 sigma move, right? Remember, 68% of the time it closes within the weekly expected move. So that can take us to potentially down to 37.50 to the upside, but we can't rule out a potential rip back up, especially if we get good news, right? That could take us to around 39.50, potentially even more if good news actually comes. And I'll show you that we are oversold in many conditions momentarily. I'll bring you back to this chart over here. This was the chart measuring the anchored VWAP from the all-time high and the October bottom. And as you can see here, we just had a weekly close outside of it. It was a very big bearish looking candle. I also not really anchored, but I guess I did to the 2022 high, the all-time high of where the trading volume is by price. And you can see this right here is where the most volume has occurred as far as trading. You can kind of see that because, right, we've been expanding, and then we went to contracting right here, and you can see we're breaking from that point right now. So if we start pushing further, it can cause obviously a lot more sell side. Now these points, they can potentially act like magnets too. So even if we were to break off, it could come right back where it might feel safe. You can think of this as actually a distribution curve too. So it's like the same thing, right? 68% of the time we can break here, we can see 2 sigma moves and so forth, okay? So seeing it break off from here, not the greatest look. And I'll tell you kind of what it is that I'm looking to do moving forward here. If we look at the daily time frame, we broke down from this channel here, measuring, right? We tagged multiple times here. We tagged multiple times here. We tagged here. We found, support from a lot of areas of confluence, and now we broke down. So if we do start ripping back up, we might want to look for a potential retest of this broken trend line and see if it just turns into a potential dead cat bounce. Now, if we look at the 15-minute chart, we're pretty much in la-la land right now. We broke far from the 5-day moving average. We broke far from the month-to-date anchored VWAP, and we're broke pretty far from the year-to-date anchored VWAP. So if you're just getting excited and want to go long, just be careful, because even if we rip right here, back up to the weekly expected move, we're below the month-to-date anchored VWAP most likely. We're right below the 5-day moving average, and we'd be below that year-to-date anchored VWAP. So there's a lot of resistance. The bears are fully in control here. So if you're going long, you need to be very, very focused on risk. If you're shorting the market, I'll show you kind of something that I'm looking at. Now, if we measure an anchored VWAP from the March high, so the month-to-date high, you can see here something interesting that took place. Price came back up. It tagged it, okay? So we, on the bounce, it tagged it, so we add a new anchored VWAP. And you can see the anchored VWAP then comes down to this level. Guess what? Price bounced up to that anchored VWAP. So we measure another one from this point, boom, price sold off, and then we bounce what? Right into that anchored VWAP. So what is it that I'm looking for to potentially see a bounce? Well, you'd want to get above this prior swing, this swing high right here, right about here, to potentially come take this anchored VWAP. And if we can get above that anchored VWAP, we might be able to go for this one. So there's a lot of downwards price pressure. These are all decelerating, right? They're all declining anchored VWAPs. Now, if we take a look at the 15-minute time frame, a couple indicators, we have a positive divergence on the RSI. You might be able to say that that's wedging, might be able to see that pop. Okay, it's a very dangerous game right now, including with all the volatility that's packed in the trading sessions for the week ahead, which I'll go over momentarily. And then we have this price momentum oscillator also curling over. So things, once again, I said that are oversold conditions. They're lighting up here on the ranges. As far as the zones go, if you don't know what these are, this is something I share with my swing trading community. Basically, what it tells us is, you could think of this as somewhat like Bollinger Bands, but it's using math from the book Misbehavior of Markets by Benoit Mandelbrot. Joe Zara created this indicator, and I'm just extracting bulk data where I can see multiple different markets globally, and I can quickly visualize what's being oversold and what's in overbought conditions, okay? And when it's all lights up green, it means it's at the lower range of those bands, and as it stands right now, we're getting a lot of that green, so things are getting, obviously into oversold conditions, okay? So that's something that I'll be watching out for, seeing the change in that. And then also, if we go to the weekly expected moves, take a look here, KRE. We're looking to, in this next week, a $5 expected moves. This is also something that I share within the Patreon community. So I don't typically share all these here, but given the amount of volatility, if you want to screenshot this so you can see the weekly expected moves for all these products that I track on a weekly basis, this shows the upper level and the lower level of those expected moves for some big products. Once again, those are things that I track. But if we take a look at KRE, we're looking at almost a $5 expected move, which is pretty gigantic. So I'd be keeping a close eye on KRE. We have some big expected moves in products like NVIDIA. That's typically normal. And then the S&P 500, right? $108 expected move. The SPY, $11 expected move. The Q is a $10 expected move. So we are in the midst of obviously just a lot of volatility to come. More on some other indicators. We have the NASDAQ Bullish Percent Index. We're getting into pretty oversold conditions here. Remember, crashes can occur from these levels, okay? But also, big rips can happen from these levels. We've seen things rotate between oversold to overbought to oversold to overbought to oversold, and eventually we'll get back into overbought condition. As far as how high the market bounces, we don't know. However, we might know that, hey, we can take our foot off the pedal on our short positions or start to look for, on the shorter time frames, basis to build and potentially go long if we start to see something like, okay, this comes down further, right? Goes like that, where we have this, lower low, but yet this comes down like this and we potentially have a positive divergence, something like that out there. BPSPX chart also into pretty oversold conditions, not surprised there. Now, if we start to get way down into these 15 or 20 regions, that's where we found bottoms prior, both in October and also in the middle of June. So that is something that I'll be watching out for. The same thing goes with the OEX, which is the S&P 100 bullish percent index, oversold. Now, if it gets, and this like S&P 100 uses, it's focused more on those, obviously the bigger market cap names. So if this starts getting into the 15 to 10 range, that can mark a potential, short-term, potentially longer-term bottom, as we've seen happen here in October. And we also saw here in the middle of June where we kind of rallied out of those levels. A couple other indicators that I want to quickly hit is the NASDAQ Summation Index, still pointing straight down. Now, remember, we talked about this potentially changing the trend, and we talked about it before it happened. We talked about this when it happened, and guess what? It worked, so it started moving down. So if you want to feel more confident about going long, wait for this to start turning back up in the parabolic SAR to get back underneath it, because it has been a helpful indicator for tagging short-term changes in trend. If we look at the NASDAQ McClellan oscillator, pretty oversold conditions. As we've seen the last time, it was way down here, and we can see that it didn't mark a bottom, but we did see it kind of come out of there after seeing a positive divergence. Also, the NYSE Summation Index pointing straight down too as well. Something that we called out was this negative divergence here, and it's starting to play out to the downside. The NYMOT, the NYSE McClellan oscillator, is getting a reading of minus 307. That is very oversold conditions. You can see here we've gotten very oversold before. That marked a bottom. We got an oversold here before. That marked a short-term bottom. We got oversold here before. That marked a short-term bottom. We got oversold here before. That marked a short-term bottom as well. Now, I will remind you, if you do not recall, this, so I'd have to pull up a longer term chart, and I'll do that on my next video if I can remember. But if you get this to cross under minus 300, at the same time the summation index crosses around minus under zero, that is actually marked the start of bigger drops in the overall market. And what do I mean by that? You can see that right here. Okay, when was the top in the S&P 500 or the NYSE New York Stock Exchange? Here in 2022, right? It peaked out in 2022 at the beginning. And what took place? We crossed down through the zero line. At the same time, we got an oversold, a big breath to the downside, minus 300 reading, and the market started moving down. The same thing that happened, I don't have it in front of me, but I know it took place before the 2018 drop. It was in 2008, and then also I believe in the pandemic, it did the same thing. I'll have to remember to bring that chart up, but be very cautious. Be careful out there, people. I went over a lot today, and really, what should we do? Well, we should focus on preserving and protecting our capital. I'll tell you what I'm doing. I've had my money parked into a savings account where I'm getting interest on it. And after this whole debacle took place with SVB, I might need to look to breaking that up a little bit. I'm not personally in a regional bank. I feel protected to an extent, but now this is kind of shaking me a little bit to the point where, like, hey, I took out money out of the markets basically to protect it, and now we're seeing stuff like this where, if you're over FDIC insured amount, it's a little dangerous. So me personally, I'm trading smaller amount of money in my trading account. I have more cash parked to the sides because I'm just not looking to take on the amount of risk. Most people, when they see this stuff happen, they look to how they can take advantage of it. And I understand why, because of Hollywood and Michael Berry, making hundreds of millions of dollars on the short, and there's nothing wrong with that. But to be quite honest with me personally, I look to just preserve that capital and protect it because I honestly do not know what could potentially happen in these markets. And the reality of it is nobody actually does. That's all I got for you on today's show, everybody. See you later.